Let me ask you something that might make you uncomfortable. When was the last time you actually looked at what's happening in the precious metals market? Not just glanced at a price chart, but really examined the forces moving beneath the surface. Because right now, there's a convergence of events that hasn't occurred in over 50 years, and most people holding gold and silver have absolutely no idea what's about to hit them. I'm not talking about the usual market volatility. I'm talking about a fundamental restructuring of how precious metals are valued, traded, and controlled. And if you're sitting on physical gold or silver right now, without understanding what's coming, you could be making a critical mistake that costs you everything you've worked to protect. Here's what nobody's telling you. The COMEX, the exchange where precious metals prices are supposedly determined, is facing something it's never dealt with before. For decades, this market has operated on a simple principle. For every 100 ounces of gold traded on paper, maybe 1 or 2 ounces of physical metal actually exists. It's been the world's most successful magic trick. But that trick is falling apart, and it's happening faster than anyone anticipated. 3 weeks ago, something extraordinary occurred that barely made the financial news. A major European bank, one whose name you'd instantly recognize, attempted to take delivery of physical gold from their COMEX contracts. Standard procedure happens all the time, right? Except this time, they were told there would be a delay, not a day or two, not even a week. They were looking at a 6-week wait for metal that, according to the contract, should have been sitting in a vault ready for immediate delivery. Now you might think 6 weeks isn't that long, but in the world of precious metals trading, where contracts specify immediate delivery, 6 weeks might as well be 6 years. It's a red flag so massive that traders who understand what it means have been quietly repositioning their entire portfolios. Because if the COMEX can't deliver physical metal on demand, the entire pricing mechanism for gold and silver becomes questionable. Let me take you back to 1980 for a moment, because what's happening now rhymes with that period in ways that should terrify anyone who understands market history. Back then, the Hunt brothers tried to corner the silver market. They accumulated so much physical silver that the exchanges changed the rules mid-game to stop them. Silver had run from $5 to $50 an ounce in just a few months. The Hunts were destroyed financially. But here's what most people forget. The reason they could even attempt that corner was because the ratio of paper silver to physical silver was already dangerously out of balance. Fast forward to today, and that ratio isn't just out of balance. It's completely detached from reality. The Silver Institute estimates there are over 300 ounces of paper silver traded for every ounce of physical silver that actually exists in deliverable form. Think about that. If even 5% of paper silver holders decided they wanted physical delivery, the entire system would collapse overnight. And here's where it gets really interesting. They are deciding they want physical delivery, not retail investors like you and me. I'm talking about sovereign nations, central banks, and institutions managing hundreds of billions in assets. China's central bank has been accumulating gold every single month for the past 18 months, not buying paper gold, not buying gold ETFs, buying physical bars and having them shipped to vaults in Beijing and Shanghai. India just announced they're setting up a gold exchange in Gujarat that will trade physical gold only, completely bypassing the London and New York pricing mechanisms. Russia has been converting dollar reserves into gold since 2014, and they're not slowing down. The BRICS nations are openly discussing a gold-backed trade settlement system that would fundamentally change how international commerce works. You know what all of these moves have in common? They're not speculating on gold prices. They're preparing for a world where paper promises about gold become worthless, and only physical metal in your possession actually matters. Now, I need to pause here for a second because this affects a lot of people watching this. If you're sitting on $100,000 or more in retirement accounts, there's something you need to understand about gold IRAs. I put together a complete guide on how these work. It's linked in the description below. It covers exactly how you can get physical gold into your retirement account without triggering tax penalties or early withdrawal fees. A lot of people don't realize this is even possible, but it's one of the few ways to get real asset protection inside a tax-advantaged account. Worth looking at if that's relevant to your situation. All right, back to what's happening in the market right now, because the timeline on this is compressing faster than most analysts predicted. The London Bullion Market Association, the LBMA, is the other major hub for precious metals trading. They recently published their annual survey, and buried in the data was something remarkable. Allocated gold accounts, where specific bars are assigned to specific owners, have grown by 47% in the last year. Unallocated accounts, where you just have a claim on gold that's pooled with everyone else's claims, have actually decreased. What does that tell you? It tells you that sophisticated money is saying, I don't want to promise that gold exists somewhere. I want specific bars with specific serial numbers that belong to me and only me. That's not speculation. That's preparation for a scenario where promises become worthless. Let's talk about what happened in March of 2020, because it's a preview of what's coming, except this time it's going to be much worse. When COVID hit and markets went haywire, something bizarre happened in the gold market. The spot price of gold, the price for immediate delivery, diverged from the futures price by over $100 an ounce. In normal times, these prices are within $1 or $2 of each other. Why did this happen? Because suddenly everyone wanted physical gold, and there wasn't enough to go around. Refineries were shut down, transportation was disrupted, and the paper gold market kept trading as if nothing was wrong, while the physical gold market was screaming that there was a massive shortage. The spread eventually closed, but only because central banks stepped in and made metal available. They papered over the crack in the system. But that crack never actually healed. It's still there, and it's getting wider. Here's something most people don't know. The gold stored at the Federal Reserve Bank of New York, which is supposed to be one of the largest repositories of gold in the world, hasn't been fully audited since the 1950s. The last partial audit was in the 1970s, and even that was limited in scope. We literally don't know for certain how much gold is actually sitting in those vaults. Germany found this out the hard way. In 2013, they asked for their gold back. Not all of it, just 300 tons out of the 1,500 tons they had stored in New York and London. They were told it would take 7 years to return it. 7 years to return gold that was supposedly sitting in a vault with Germany's name on it. Why would it take 7 years unless that gold wasn't actually there and had to be acquired from somewhere else? Now multiply that scenario across every nation and institution that has gold stored in New York and London, and you start to understand the magnitude of what we're dealing with. If everyone who thinks they own gold actually tried to take possession, the system would implode. The silver situation is even more precarious. Silver has this unique characteristic where it's both a monetary metal and an industrial metal. It's used in solar panels, electronics, medical equipment, and increasingly in electric vehicle production. Unlike gold, which mostly just sits in vaults, silver gets consumed. It gets used up in manufacturing processes where it's not economically recoverable. The Silver Institute's latest data shows that industrial demand for silver is outstripping mine supply by over 200 million ounces per year. That deficit is being filled by above-ground stockpiles, but those stockpiles are finite. At current consumption rates, some analysts estimate we have less than 5 years of available silver inventory left. What happens when that inventory runs out? What happens when solar panel manufacturers and electronics companies are competing with investors for a metal that's suddenly in genuine shortage? The price doesn't just go up, it explodes. And if you're holding paper silver when that happens, you're going to discover that your paper claim is worthless because there's no physical metal to back it up. Let me tell you about a conversation I had with a bullion dealer last month. This is someone who's been in the business for 30 years, who's seen every market cycle, every panic, every boom and bust. He told me something that should concern everyone holding precious metals. He said the premiums on physical silver, the amount above spot price that dealers charge for actual coins and bars, are higher now than they were in 2020 during the peak of the COVID panic. And this time, there's no obvious crisis driving it. What's driving it is that the people who actually handle physical metal every day, the dealers and refiners and vault operators, they can see what's coming. They're not willing to sell physical metal at prices that are being set by paper trading in New York and London, because they know those prices don't reflect reality. Here's another piece of the puzzle that most people miss. The mining industry is in serious trouble. The average grade of gold ore being mined today is less than half what it was 20 years ago. That means miners have to move twice as much rock to get the same amount of gold. Costs are rising, but the price of gold, at least the paper price, hasn't kept pace with those rising costs. What happens when it becomes unprofitable to mine gold at current prices? Production drops, supply decreases, and suddenly the deficit between what the world wants and what the world can produce becomes even more severe. We're already seeing this play out. Major gold mining companies have been cutting exploration budgets for years. They're not finding new deposits to replace the ones being depleted. The pipeline of future gold production is drying up, and it takes 10 to 15 years to bring a new mine online, even if you do find a deposit worth developing. Silver mining faces the same challenges, but with an added complication. Most silver isn't mined from primary silver mines. It's a byproduct of copper, lead, and zinc mining. If those base metal prices don't justify mining operations, silver production drops, regardless of what silver prices are doing. Miners can't just decide to produce more silver because the price is high. They're constrained by the economics of the primary metals they're actually mining for. Now let's talk about what's happening in the ETF market, because this is where things get really concerning. The largest gold ETF, GLD, is supposed to hold physical gold that backs every share. But if you read the prospectus carefully, you'll find some interesting language. The ETF doesn't guarantee that you can ever exchange your shares for physical gold. You own shares in a trust that owns gold, but you don't own the gold itself. What happens in a scenario where the price of physical gold diverges significantly from the price of paper gold? What happens when people realize that their ETF shares might not be convertible to actual metal? We got a taste of this in 2020 when some gold ETFs were trading at discounts to their net asset value, which should be impossible if the arbitrage mechanism is working properly. The arbitrage mechanism only works if authorized participants can actually get physical gold to create new ETF shares or can actually redeem ETF shares for physical gold. If that mechanism breaks down because physical gold isn't available, the ETF price can diverge from the gold price, and suddenly your gold investment isn't tracking gold at all. There's a reason why central banks don't hold gold ETFs. They hold physical bars in vaults. There's a reason why the ultra-wealthy don't hold gold ETFs. They hold allocated gold in private vaults. These institutions and individuals understand something that most retail investors don't. In a real crisis, paper claims become worthless. Let me paint you a picture of what this looks like when it actually happens. In 2013, Cyprus had a banking crisis. The government decided to confiscate a portion of bank deposits to bail out the banks. People who thought their money was safe in insured bank accounts woke up one morning to find that a chunk of it was simply gone. Now imagine that scenario, but with precious metals. You think you own gold through an ETF or an unallocated account. A crisis hits. The institution holding that gold, or claiming to hold that gold, faces a liquidity crunch. They make a decision to suspend redemptions, or they impose a cash settlement at a price they determine, or they simply declare force majeure and walk away from their obligations. You're left holding a piece of paper that says you own gold, but you can't actually get the gold. And by the time the legal process works itself out, if it ever does, the crisis has passed and your opportunity to protect your wealth has evaporated. This isn't theoretical. This has happened repeatedly throughout history. It happened with gold in 1933 when Roosevelt confiscated private gold holdings. It happened with silver in 1980 when the exchanges changed margin requirements and liquidated the Hunt brothers' positions. It happened with MF Global in 2011 when customer funds were used to cover the firm's trading losses. The pattern is always the same. Everything works fine until it doesn't. And when it doesn't work, the people holding paper claims are the ones who get destroyed while the people holding physical assets survive. Now here's what makes the current situation so dangerous. We have more paper claims on precious metals than ever before in history. We have more geopolitical tension than any time since the Cold War. We have more currency creation and debt accumulation than any time in human history. And we have a generation of investors who have never experienced a real monetary crisis and don't understand how quickly things can fall apart. The smart money isn't waiting to see what happens. They're acting now. When you see central banks accumulating gold at the fastest pace since 1967, that's not a coincidence. When you see billionaires like Ray Dalio publicly stating that everyone should have gold in their portfolio, that's not casual advice. When you see countries like China and Russia actively working to create alternatives to the dollar-based financial system, that's not just geopolitical posturing. These are preparations for a monetary reset that's coming whether we're ready for it or not. The question isn't if the current system breaks down. The question is when and what position you're in when it happens. Let me be very specific about what I mean by a monetary reset, because this term gets thrown around a lot without clear definition. I'm talking about a scenario where the relationship between paper currencies and real assets fundamentally changes, where the promises made by governments and financial institutions are revealed to be unsustainable, and the market demands real value instead of paper promises. This has happened before. It happened in Weimar Germany in the 1920s. It happened in Zimbabwe in the 2000s. It happened in Venezuela in the 2010s. It's happening in Turkey and Argentina right now. The pattern is always the same. Governments print money to solve short-term problems, the currency loses value, people flee to real assets, and the paper monetary system collapses. The difference this time is that it's not just happening in one country or one region. The entire global financial system is built on a foundation of debt and currency creation that's unprecedented in human history. The United States has over $35 trillion in federal debt. That number was 5 trillion just 25 years ago. It's grown sevenfold in a single generation. How does that debt get repaid? It doesn't. It gets inflated away. The government prints more money, the currency loses value, and the real burden of the debt decreases. But that process destroys the savings and purchasing power of everyone holding that currency. Gold and silver are the traditional hedges against this process. They're the assets that maintain value when currencies lose value. But here's the critical point. Only physical gold and silver provide that protection. Paper claims on gold and silver are denominated in the same currency that's losing value. If the dollar collapses, your gold ETF shares are still priced in dollars. Your unallocated gold account is still a dollar-denominated claim. Physical metal in your possession is the only thing that's truly outside the system. It's the only thing that can't be inflated away, confiscated with a keystroke, or devalued by government decree. Now, I know what some of you are thinking. This sounds extreme. This sounds like doom and gloom conspiracy theory stuff. But let me ask you this. 5 years ago, would you have believed that the Federal Reserve would create $4 trillion out of thin air to buy bonds? Would you have believed that interest rates would go to zero and stay there for over a decade? Would you have believed that the government would send checks directly to citizens and call it stimulus? All of those things happened. They're not theories, they're facts, and they represent a fundamental change in how the monetary system operates. We're in uncharted territory, and the historical playbook says that when you get this far into monetary experimentation, the ending is never smooth. The time to prepare for a crisis is before the crisis happens. Once everyone realizes there's a problem, it's too late. The premiums on physical metal spike. Availability disappears. Dealers run out of inventory. And you're left trying to acquire protection at exactly the moment when it's most expensive and hardest to find. We saw this in 2020. We saw it in 2008. We saw it in 1980. Every time there's a crisis, the same pattern repeats. Physical precious metals become scarce. Premiums explode, and the people who waited to act end up paying 2 or 3 times what they would have paid if they'd prepared in advance. Right now, we're in the calm before the storm. Physical metal is available. Premiums are elevated, but not catastrophic. You can still acquire real assets at prices that, while high by historical standards, are nothing compared to what they'll be when the crisis actually hits. But that window is closing. Every month, more people wake up to what's happening. Every month, more institutions shift from paper to physical. Every month, the available supply of physical metal shrinks while demand grows. If you own precious metals right now, you need to ask yourself a hard question. Do you own paper or do you own metal? Do you have a claim on gold or do you have gold? Because when the system breaks, and it will break, that distinction is going to determine whether your wealth is protected or destroyed. The alert in this title isn't hyperbole. Time really is running out to act. Not because the world is ending tomorrow, but because the window to prepare at reasonable prices is closing. The smart money has already moved. The question is whether you're going to join them, or whether you're going to wait until it's too late, and then wonder why nobody warned you. This is your warning. The system is breaking. The evidence is everywhere if you know where to look. And the only question that matters is what you're going to do about it.